Hey guys, welcome back to the channel. My name is Zach Collins and this is Financial Education. Now today we're doing a compilation video of the first 3 episodes in my superannuation series. So this is all about the superannuation accumulation side of superannuation. Coming out in a couple of months will be the 3 episodes about pensions. But for now, I hope you enjoy everything you need to know about accumulation of super. This is going to be the first video in a mini-series I'm doing on superannuation. I did a video last year going into the basics, but I thought this year I'll do a deeper dive as there is a lot that people need to know and it's quite a complicated topic. For those that don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FASEA compliant, and I specialized in super and non-super investments. I'm not licensed anymore, but I would love to get my license back one day. I left the industry as I could not stand the owner of the business, and I've got no interest in sales. I mean, it's not all sales, but my passion is to help people, not to sell various managed funds or insurance products. These days, I work with tax. Previously, we discussed conditions of release, the different types of funds, industry, retail, and SMSF, and also how they invest those funds. Finally, we briefly mentioned salary sacrifice. I'll be covering a few of the same topics, just in a bit more detail over the course of the next 6 videos. Today we'll be focusing on the accumulation phase of super, specifically super funds and the purpose in general when it comes to retirement. Let's start from the beginning, okay? The first thing that needs to emphasize is that superannuation is a special type of trust, SPV, or special purpose vehicle. And the special purpose of super is to help pay for your retirement. If you watched the previous video I did on trusts, you'll remember that I said that all the income of a trust needs to be distributed, or the trustee will pay tax on it at the top marginal tax rate of 45%. While super is a trust, there's an exemption for super funds, and that's under Section 99 and Section 99A of the 1936 Income Tax Assessment Act, and funds are allowed to accumulate income. Trustees are still liable to pay tax, not the members, but the rate is lower, and I'll go into that later in the series. Up until fairly recently, there wasn't much choice as to what super fund you could go with. This changed on the 1st of January 2021 and meant that employers are able to choose whichever super fund they want rather than being limited to the one that their employer specifically offered. Well, it came in then. It actually took a few years for changes to really happen. I used to work for a supermarket and their default fund was Rest Super. This was written specifically into the EBA. I can't remember when that EBA expired. It was many years ago. But even though the law said you could choose your fund, the EBA did not allow it. And this was allowed to continue until the next EBA was voted in, and that was after I left. It goes to show that even though technically employees had more options about where they could put their super, it wasn't actually allowed through a lot of employers. Thankfully, I think all EBAs have expired and have since been renegotiated, and now everyone can freely move their super. But yeah, there was a time when legally you could move your super anywhere you wanted, but your employer didn't have to accept it. When the choice of funds opened up employees to whatever fund they wanted, this also led to something called the stapled super laws. What is stapled super? So stapled super was a new introduction by the Liberal government. And what it meant was that if you had a super account from an old job that met the conditions, your new employer would have to pay to that old account, and they couldn't just create a new one with their default super fund if you didn't provide them with the info. Now, let's be honest, how many people actually know the super details? This is why I have my channel, because I've come across so many people that do not know the basics of personal finance. And if this is you, I hope you watch my videos and you grow that knowledge. But yeah, as I was saying, most people have no idea. So if they don't know, they can't tell their employer. And so this saves them from having multiple super accounts with different providers, paying multiple sets of admin fees and insurance and other fees, eroding their balance and reducing their retirement savings. Now, not all super funds qualify to be a stapled fund. The conditions mean that it has to offer a My Super product. My Super product being a single diversified investment strategy. This means it's invested in a range of different equities in the one single product. It's got Australian shares, international shares, property, bonds, and cash at a minimum. Now, most of these products will be rated as balanced. They have a growth percentage between about 70 and 80%. Another condition to be a stapled fund is that they need to have default insurance that comes with a minimum level of death cover. The vast majority of super funds allow you to hold insurance through the fund. However, not all of them will provide it to you as a default. Most industry funds would. I haven't met any that don't. But yeah, insurance needs to be an opt-out rather than an opt-in. There also needs to be limitations on the fees that they charge. Most retail funds wouldn't meet these conditions, but industry funds would. One thing worth mentioning is that this only applies to employees that started on or after 1 November 2021. So if you started with the employer before then, they wouldn't have been able to see your stapled fund. Hopefully by now you've told them and they're paying you properly. But next time you move jobs, your employer will have your stapled fund there to contribute to without you needing to do anything. Along with stapled funds also came the Your Future, Your Super legislation. And what this is doing is each financial year, the government releases a comparison of different super funds showing the performance of their MySuper products against every other MySuper product on the market. This is designed so that you can have a look at how your fund is doing each year and whether they're performing to the level that they should. If they're not, you can see what other funds are meeting the benchmark and maybe you can move. The benchmark gets updated each year because obviously the market changes each year, and you can't have it at a set growth percentage because some years you'll see every fund outperform, and other years everyone will underperform. And it's not a very good measure of comparison. If it's what the government does with the benchmark is if a fund underperforms the benchmark multiple years in a row, it locks it from acquiring new members until they can improve. What this has meant is that for a lot of smaller funds is that they're not meeting the requirements. Instead of waiting for government intervention, they've been merging with other funds quite early on, and that helps consolidate the investment strategy, and it gives them greater economies of scale, resulting in increased performance. What a lot of industry funds have been doing to grow their membership base to get to that economy of scale is advertise. Now, this is actually really controversial in super legislation. In order for the trustees to spend money that it gets from members such as admin fees, they need to prove that it's in the best interest of the members. Now, this legislation was then changed at the end of 21 from best interest to best financial interest. I would argue that advertising is not in the best financial interest of the fund, but they've gone away with it for years, so we'll see. We'll have to see. What most people will be familiar with is something called a defined contribution super. Everyone nowadays would have one of these. What does this mean? A defined contribution is if you work a job. Let's say you earn $100,000 a year and your super guarantee is 12%. So that's $12,000 a year. That means each year you're putting in $12,000 into your superannuation. The contribution is defined. You have your own account, you have your own balance, and your balance is 100% reliant on your contributions each month or year. If you don't contribute, the amount might go up or might go down based on returns and fees, but it is segregated specifically to you and is reliant on what and how much you put in. This contrasts with something called defined benefit, in which there is no real defined account. So these defined benefits, they've been wiped out as they're mostly government funds, and they're no longer open to new members. And as these older members die off, the number of account holders reduces. What is a defined benefit super account? It differs from a defined contribution because generally the amount you put in is irrelevant. You don't have a distinct account balance. All your funds are pooled into one account, and there's some magic formula that they use once you start drawing a pension as to how much they give you. It's normally a factor of the last 3 to 5 years of your income multiplied by your service period and then by some other number. And this amount is then paid to you for life. It gets indexed each year in line with CPI. However, how much money in the kitty is irrelevant. Whether the market went up or down is irrelevant. If the country is in recession, it's irrelevant. None of these factors in how much you get paid. The reason these defined benefit accounts have been closed to new members is because they were so generous that the government was losing money offering them because they were mostly government employees. And so if there's not enough money in the fund to pay out members, it's on the government, i.e. taxpayers, to fund the retirement of these people. There are 5 different types of super funds, as I briefly mentioned in my first super video, being industry funds, retail funds, SMSFs, small APRA funds, and government super. These are the different breakdowns of how popular each super fund type is. As you can see, industry funds are the most common. However, in terms of actual dollars, SMSF and industry funds are both at a very similar level. When you compare how much assets is held in super environment, you'll actually see that there is more money in super than the total market cap of the ASX. With the ASX being $1.6 trillion in total assets, super being $1.5 trillion. That is huge. Basically, if super funds only invest in the Australian stock market, they could own all of it. That'd be really bad for the economy, having all your wealth consolidated and controlled by only a few entities. Interestingly enough, super is much larger than the GDP of Australia. We could buy every good and service produced in a year about 1.5 times over. As you can probably imagine, when I said earlier that industry funds has the most members, in terms of dollars, SMSFs had the same amount, but there were probably some really large SMSF balances. The largest SMSF has about $400 million in 2020. What? How can you accumulate that much money? It's absolutely insane. And if you look at the Tax Expenditure Insights, also known as TICE, released by the ATO and Treasury each year, you see that super as a whole is costing the government $1.5 billion from the concessional tax treatment. And welcome to part 2 of the mini-series on superannuation. Now, today we'll be looking at contributions and super guarantee. Let's start off with what is a contribution. Now, this is elaborated in TR 2010-1, and it basically says that any transfer to the fund. I'll link below the TR as there's more, but it includes cash, electronic transfers, and promissory notes. Now, Division 290 to 293 of the Income Tax Assessment Act 97 discusses different types of contributions that can be received by the fund. Division 295 talks about what is considered to be income of the funds, and Division 301 to 307 goes through the benefit payments and the tax treatments of that. There are a range of different requirements as to when you can make a contribution, how much that contribution can be, and also the tax treatment of that contribution. It's a very convoluted system, and it's really tough to navigate. I guess that's why I'm making this series, to help people understand super better. The basic contribution requirement for your super fund to receive SG is that you need to be working. All super funds will accept SG for you no matter what your age is. However, if you're not working, you aren't earning SG. For concessional contributions, you need to be age 74 or younger. There are catch-up contributions which have different requirements, and I'm going to talk about that on the next episode. For non-concessional contributions, there was both an age requirement and a balance requirement. This is also something I'll look into further on the next video. When it comes to contributions, let's start off with superannuation guarantee, or SG. SG is a mandatory contribution to super made by your employer. If you are earning a salary of, say, $100,000 plus super, then you'll be getting super guarantee of 11.5% on that salary. It will actually be 12% from 1 July 25, and that gets paid directly to your super fund, so you never actually receive those dollars in your hand. This type of contribution is taxed at a concessional rate compared to if you had received that personally. When it gets added to your account, the super fund will pay tax on that contribution at a rate of 15%. If you were to receive that amount personally, that $12K would get taxed at your marginal tax rate, which in the example I'm using would be in the 30% tax bracket, and so you're saving 15% tax by having to go into super instead of personally, plus 2% since you don't pay a Medicare levy on it either, so really it's a 17% tax saving. Before I go into contribution limits, I need to make a few additional comments directly relating to SG. So contributions made by the employer, currently they need to be paid at a minimum of quarterly. They can pay it more frequently, but the government has passed legislation for payday super, being that the employer needs to pay your super when they do your payroll. That's not coming in until 2026. In the meantime, employers have until 28 days after the end of the quarter to pay your super. So for the January to March quarter, you might not be paid until the 28th of April. Obviously, they can pay it earlier, but that's the latest they are allowed to pay your super. Important thing to note in relation to this is that when it comes to the timing, that it's not counted from when your employer pays. It's counted from when the super fund receives it. If the employer pays on the 20th of April, but the super fund doesn't receive until the 1st of May, it's late. With the caveat being that the ATO super clearinghouse, if they use a private clearinghouse, the timing is when the super fund receives the contribution. If they use the ATO clearinghouse, it's when the ATO receives the money that counts for timing. If they don't pay on time, there's something called the SG charge. And this is a penalty placed by the ATO on the employer for failing to pay your super on time. This is charged at a rate of 10% and is not a deductible expense, which is what matters to employers. I found employers are happy to flaunt the rules, not pay their tax on time, and then when they get the SIC, or shortfall interest charge, or GIC, general interest charge, these are tax deductible, so they don't care too much. With the SG charge being non-deductible, they're a lot more likely to pay on time. So who is entitled to SG? Almost everyone, but not everyone. Up until recently, if you earned under $450 in a month, the employer was not required to pay you SG. This has thankfully been changed, and there's no longer a lower monetary barrier to earning SG. There is an age barrier, however. If you're under the age of 18, employers are not required to pay SG unless you work more than 30 hours in a week, which means unless they've left school and are working full time, it's unrealistic. So essentially, no 18-year-old is earning super. One thing to note with this is requirements. So employers are not required to pay super guarantee to under 18s. Doesn't mean they don't. Some will still pay even though they're not legally required to. SG is also not accrued on overtime, only on your ordinary time earnings, or OTE. If you work a salary at say 60 grand and you get 20k of overtime each year, you're not paid super on 80k, just the 60k base. The government has also implemented something called a maximum earnings base for super, and this is around $58,000 to $59,000 per quarter. What this means is if you earn more than this, make sure you check your contract, because employers are not required to pay you SG over the earnings base, which is around $235,000 per year. So SG on 235k is about $27,000. If your contract explicitly says X amount plus super and it doesn't specify a cap, they need to pay you the full amount, and this needs to go to your super. They cannot pay it out to you as wages. If it says Y amount up to the maximum earnings base, then even if that 11.5% should be say $30,000, you're only getting 27 grand paid to your super account. There are also special rules for contractors, and this came out in the SGR 2005-1. Now, SGR being Superannuation Guarantee Ruling, and this says that if you are paid for labor and you have no right to delegate work, i.e. you're basically just paid for your time, either wholly and principally for your labor and not paid for your specific result, then you're considered to be an employee. And if you're considered an employee, then you are entitled to super guarantee. What a lot of dodgy businesses will do is they will ask you to create an ABN, and they will pay you through that. They will say that because you're paid via ABN, you're a contractor, not an employee. And as a contractor, they don't need to pay you SG, which is wrong. This tactic is well known, and it goes by the name of sham contracting arrangements. The other thing to note for SG requirements is that directors could receive SG if they've been paid a wage for their role in the business. Sole traders are not required to pay themselves SG, and this is where they get into trouble, is they work as a sole trader for say 10 years. They don't pay their super, and the business is only slightly profitable. They might end up closing it down with very little to show at the end. It's probably obvious, but dividends do not attract SG. A lot of small business owners will pay themselves both a salary and a dividend. Salary attracts SG, dividend does not. Division 291 and 292 talk about the contribution caps, and there need to be caps on how much money goes into super. Because someone that's very wealthy and can afford to forego income shouldn't be getting a bigger tax break than the average Australian. Currently, the contribution cap for a concessional contribution, that is the type of contribution that you don't pay tax on personally, and I guess the concessional tax treatment of 15% tax, is $30,000 per year. Now, there are 5 types of contributions that get treated as concessional contributions. The first one, which I already mentioned, is your super guarantee from the employer, and this is a mandated contribution. If they're generous, which 99.99999% of employers are not, they might also decide to pay you more than the minimum. This is called a voluntary employer contribution. Basically, this means anything over the minimum SG rate. Next, we have salary sacrifice, and this is where you ask your employer to add an additional amount of super. This gets taken from your pre-tax salary and gets paid directly to your super account. We have personal concessional contributions. This is where you get paid an amount and you pay tax on it personally. You then contribute to your fund post-tax, but you lodge an NOI, a notice of intent to claim a tax deduction form with the super fund. They will then take out that 15% tax, and then when you lodge your taxes at the end of the financial year, you get a tax deduction on that amount you put in. The final one, which you might not actually consider a contribution, is employer-funded insurance. Now, this might sound wrong, but if you're not paying for it, it's considered extra income or an extra benefit provided by the employer. If the insurance is $100, then it's $100 less of the cap that you can use. If it's 10K, then it's 10K less available for you to use. So this is something important to bear in mind when you're thinking about contributing more to your super. All of these contributions are treated equally in the eyes of the ATO and super law, and they're all included in the cap of $30,000 a year. If you exceed the cap, the super fund will need to take extra tax to turn it into a non-concessional contribution, and it will be taxed at your marginal rate. There are other rules around carry forward contributions that I'll go into in the next session, but for now, just know that the cap of concessional contributions is 30 grand a year. While concessional contributions normally get taxed at 15%, there is one exception, and that's Division 293. Division 293 is an additional 15%, so a total of 30% tax for high income earners. By high income earners, we're talking people that make over $250,000 a year inclusive of super. To be earning that much, you're in the top 5% of earners. So, I don't know about you, but I don't really feel too sorry for people earning that much income, for them to pay a little bit more tax and to even the playing field a little bit. When it comes to non-concessional contributions, there are different higher limits to what you can put into super. The non-concessional contribution cap, NCC cap, is set at 4 times the CC, concessional contribution cap, which is currently 30K. So NCC is 30 times 4, being 120. The reason this is higher than the concessional cap is because this is post-tax money. The government is happy for you to put money into super post-tax because they've already received a decent chunk from you. But to get the low tax rate, they don't want to give it away too much. I'm not going to talk too much here today about NCCs. That's what we'll dive into more in the next episode. But before I finish this episode, I need to talk about why people love super. And it's not just because of the tax deduction they get for contributing up front. It's the ongoing lower rate of tax that super receives. Division 295 talks about the tax rate of the fund income, and Division 301 to 307 talks about benefit payments. There's 2 types of fund income to consider, and they each have different tax rates. Think income and capital gains. Income from interest or dividends or rent is treated the same within super as contributions. This means that any income of the fund generates will be taxed at 15%. If you were to own the same investment outside of super, you'll retain tax on this income to your marginal tax rate. So not only is it beneficial from an initial tax saving perspective, you also get long-term tax savings. Capital gains are slightly different when held through super versus when held personally. When you own an asset and sell for profit that you own personally, if you held it for more than 12 months, you get a 50% discount on the gains. So you'd only get half added to your taxable income. When this asset is held within super, you get a 1/3 discount. This means instead of paying tax on the gains at 15%, you pay tax at 10% for long-term gains. So if you make $100,000 in long-term gains, you only pay tax of $10,000. Pension assets and income from drawing a pension is fully tax-free. I'll get into more detail about this later. We've got 3 episodes specifically on pensions. The final thing I want to mention is a change the government has made in regards to the taxable income of a super fund that only affects large balances. Currently, it doesn't matter how large your super balance is, you pay a maximum tax of 15%. What the government is implementing is for balances over about $3 million, which is currently very few. But over time, as they have said it will not be indexed, a lot more people will be affected, is that tax will be increased to 30% for the amount over $3 million. It's not 100% clear how they will enforce it, but it sounds like they will tax unrealized gains. So if your balance goes from $3 million to 3.1, they will tax that $100,000 gain at 30%, even though you haven't sold anything or generated an income on that amount. Time will tell how successful that is, as it's not coming in until 2026, so we have a little bit more time to work out the kinks. And welcome to part 3 of the mini-series on superannuation. This is the last video on the accumulation phase. Soon we're moving into pension phase of the super. Today we'll be going into details surrounding the different types of contributions there are and the different caps and limits, as well as the scenarios that you can withdraw your balance. Let's start off with free money. Who doesn't want free money? No one. Thought so. Now, the government rarely gives away money for free, unlike the US where they got stimulus checks during the COVID. But unless you're on government payments or your employer was in difficulties and you've got the extra payment of JobKeeper, there's no free lunch here. For low-income workers, however, there are 2 ways the government will boost your super balance, and that is through the co-contribution scheme and LISTO. The co-contribution used to be a 1-to-1 bonus. If you contributed $1,000 in non-concessional contributions, if you remember what I said last time, how concessional is pre-tax and non-concessional is post-tax. So the co-contribution requires you to contribute to super after you've already paid tax on the money in order to get to it. As I said, it used to be a one-to-one bonus. If you put in $1,000, the government would also contribute $1,000. Now, however, it's a 1 to 0.5. So you get a maximum of $500 for the $1,000 you contribute. Now, there are thresholds for contributions, which I'll link below. But basically, if you want the maximum amount, you need to be earning under 45 grand, and you still get a little bit of benefit, but it cuts down up to around the $60,000 mark. Now, LISTO is similar but different. This stands for Low Income Superannuation Tax Offset. For this one, you have an adjustable taxable income. This factors in other income and deductions, so it's slightly different to your bulk stat taxable income. And below 37 grand, you'll get tax on your superannuation paid back into the account, up to a maximum of about $500. So as I've said before, that concessional contributions pay tax at 15%. If you're earning under 37 grand and you get 12% super guarantee, that's $4,440 in contributions. You'll pay tax of $666 in tax. The government will give you back $500. So essentially, you're only paying $166 in tax on the contributions, and it really helps boost your super balance. If your spouse is a low income earner, you could also consider doing a spouse contribution. A spouse contribution is a specific type of contribution, and it would be included in their non-concessional contribution cap, as it provides the higher earning partner to get a tax offset up to $540. This is calculated on 18% of the contribution, up to a cap of about $3,000, where the income does not exceed 40 grand. So that means is if they earn 38,000 and you contribute 4, only the $2,000 difference between 40K and 38 would be counted, and you get the tax offset of $360. However, if they earn 36 grand and you put in 4K, the max you can get is offset of 80% on the 3 grand, being $540. When it comes to certain contributions, your total super balance is very important. I'll go into more detail about the different types of contributions a bit later, but if you want to utilize your carry forward concession contributions, your TSB cannot be over $500,000, and bring forward non-concessional contributions are affected if your TSB is over $1.9 million. So what are the carry forward and bring forward provisions I just mentioned? In the 2018-19 financial year, the government started allowing people to carry forward the concessional contributions that they didn't use. What does this mean? If your employer pays $10,000 into your super and you have a concessional contribution carry of 25, which is what it was at the time, it means there's $15,000 unutilized. You can carry forward that $15,000 into the future for up to 5 years, after which it drops off. So then, in the 2019-20 year, you could have used $25,000 for that year, plus $15,000, and contributed $40,000 concessionally to your super. As I said, this drops off after 5 years. If you do want to use up the cap from previous years, what you need to do is maximize the cap for the current year. Today that'll be 30 grand, and then any amount over this will automatically be deducted from the oldest year first. Let's say you have $15,000 per year spare. If you put in $50,000 this year, you'll use up the current cap of 30 grand. 15,000 will be attributed to the one from 5 years ago, and then to the one just after that, $5,000. As I said before, if your total super balance is over 500 grand, you cannot use the carry forward concessional contributions. It's not to say they won't keep accumulating, you just can't use them. The government allows you to continue to build up those carry forward contributions because the market does not always go up each year. Sometimes you'll lose money, and so if your balance drops below 500 grand, then it's up to you whether you want to use them or not. The 3-year bring forward rule is similar, except instead of using past contributions, it uses future years. So you can bring forward up to 3 years of contributions. This is currently a cap of $120,000. The NCC cap is actually calculated as 4 times that of the concessional cap. So the concessional cap is indexed at a WOT, average workers over ordinary time earnings. Because the concessional cap increased to 30K, 4 times 30K becomes 120. Interestingly enough, if you bring forward years and the cap gets indexed, you don't get the benefit of the index cap. Let's say today you contribute $360,000. That would use up all 3 years of your bring forward. It means for the next 2 years you cannot make any NCCs. This can be hard sometimes as people contribute in many different ways, so you need to be vigilant to not breach this. If you don't use the full amount, let's say you do 150 grand, you still trigger the bring forward provisions, and that means that over the next 2 years, you can contribute a maximum of $210,000. If you make an NCC of 50K in year two, it then leaves 160K for year three. Now, let's say in year three, the cap gets indexed. If you did bring forward this year, you would have 3 years at 390K instead of 360. The additional amount does not get added to your current limit. You are limited to what the cap was at the time that you started your bring forward. An additional thing that needs to be factored into your non-concessional contributions is a transfer balance cap. If your total super balance is over 1.9, you cannot contribute any NCCs to super. If your balance is over 1.78, you cannot use the bring forward and you can only contribute up to 120K. If your balance is over 1.6, you can only bring forward 2 years and contribute up to 240. And if your balance is below 1.66, you can use all 3 years for 360 grand. I'll link the ATO website below where you can get more information. As you can tell from the different types of contributions, the tax treatment of these contributions differs. That doesn't matter for you or your spouse, but it does matter for any dependents that may receive your super balance upon passing. There are 3 types of super balances: tax-free, that is your non-concessional contributions, and it gets paid to your beneficiaries completely tax-free. Taxable taxed, this is your concessional contributions, and it gets a 17% tax applied to it. That's 15% tax plus 2% for Medicare levy. Finally, we have taxable untaxed. It's not a very common type of contribution type, such as for certain government and defined benefit funds, where they don't tax the money coming in and only on the way out. Why am I talking about this? That's because there's something called the recontribution strategy. Older, wealthy families use the recontribution strategy to turn their taxable taxed amount into tax-free. How do they do that? Firstly, they need to be able to access the super and pull it out tax-free. Then they recontribute the super using non-concessional balance and any bring forward provisions they can and put the money into super where no tax is taken from that amount and is now part of the tax-free balance. Important to note is that when I say wealthy, this is people that aren't already maximizing those NCC contributions. They might have 1 to 1.5 million super. They're in the top few percentile of super balances and wealth, but they're not the ultra wealthy with multi-millions in super. The other thing when it comes to super is when you want to recontribute to super, you want to make sure that you put that amount into a different account. This is because if it was to mingle with your current balance, let's say you got a $500,000 balance, fully taxable taxed. You pull out 300K and then you recontribute a 300K. You can either have 2 balances, one with 200 grand, which is fully taxable tax, and a second of $300,000 fully tax free. Or you can have one balance of 500K, but 60% will be tax free, 40% will be taxable taxed. If you were to then do the recontribution strategy a second time, in the first scenario, you could pull out just the 200K, just the taxable taxed, and you could then put it back into the tax-free account. However, in the second scenario, unless you pull all of it out, only 40% of what you pull out will be taxable taxed, 60% will be tax-free. So you're pulling out money that you don't want because the percentage does not change with withdrawals, and you cannot specify what type of contribution or what type of fund balance that you pull out. There are other types of contribution that I'll go into quickly. The first is the downsizer contribution. It's an attempt to get people to free up large freestanding homes by older people. The requirements are they need to have owned a home for more than 10 years and have lived in it for some time, and it is eligible for the main residence exemption, either full or partial. Currently, you can only put in about $300,000 per person, and you have to be over the age of 55. When it comes to the downsizer contributions, it completely disregards all other contribution limits. There's also something called the Small Business CGT Retirement Exemption. I'll put a link in the description for more information. The final contribution that I want to mention is something very specific, and it's called the COVID recontribution. This is only available to people that withdrew money during the COVID release of funds. There is a specific form you need to fill in if you want to claim it. However, this is allowed on top of your NCC limit, and it's not allowed to be made as a concessional contribution if you want to use this limit. So if your cap is say 120, you want to make a contribution of 130, you'd fill in the form and get the ATO to recognize that the extra 10K that was over the cap was a COVID recontribution. That's it with the contribution types. Oh, that was a lot. Hopefully there's a few people still watching. Before we move on, there are a few things to keep in mind when you make a non-concessional contribution and you want to turn it into a concessional contribution. Essentially, to get a tax deduction on that amount. In order to do that, you need to lodge an NOI form for the fund. NOI standing for Notice of Intent to Claim a Tax Deduction. This needs to be done before you make any transactions on that account. If it's done after, it will be invalid. So you need to make sure you lodge the form and it gets acknowledged by the fund before you roll over to a new super fund or before you start a pension with that balance. When it comes to timing, the latest you can submit the form is either before you lodge your tax return for the financial year or the end of the next financial year. So let's say you make a contribution on the 25th of June, 2025. You can only claim the deduction in the 2025 financial year. And if you want to claim it, you need to make sure you lodge the form before you lodge your tax return, being the end of October 2025 if you lodge yourself, or mid-May 2026 if you lodge with an accountant. Bear in mind that this is also the last point you can claim. If you lodge your return before those dates, you're too late. If you don't lodge your tax return at all, which everyone should be doing, you have until the 30th of June 2026 to claim that tax deduction. If you send in the form after any of those prior mentioned events, it's going to be completely disallowed. Now moving on. So super is generally locked and untouchable. I'll go into a few scenarios that you can access it earlier. You can potentially do it for certain medical reasons or if you're under financial distress. I won't talk about those today, but I'll link more information to these on the ATO website. If you're on a temporary visa, you can claim your super when you leave the country. This is known as DASP, or Departing Australia Superannuation Payment. There are a lot of people online that think if they leave the country temporarily, they can access the super. That's not true. The requirements to claim are that you accumulated superannuation while working in Australia on a temporary resident visa issued under the Migration Act. The visa has ceased to be in effect, so either it's expired or cancelled. You have left Australia and you do not hold any other active Australian visa. And finally, you are not an Australian or New Zealand citizen or a permanent resident of Australia. So if you ever get your PR or your citizen, you can never access your super early using the DASP. I'll leave a link in the description for more info. However, be mindful that your super will be taxed. I've got them on the screen for you now. As you can see, working holiday makers pay a much higher rate of tax on the super withdrawal than other visa classes. There are two main ways, however, that the average person can draw money out of their super as an Australian resident. The first is using the First Home Super Saver Scheme, which I've mentioned in the previous video. This is where you contribute money to super up to about $15,000 per year, which is allocated to your FHSSS. And other is by meeting the preservation age and condition of release rules. At this point in time, preservation is age 60 for everyone. There was a time when it was 55, but over the last few years, the government has been slowly raising that age. What does preservation age mean? It means your balance is preserved and you cannot touch it, other than for the reasons I discussed previously, until you meet that age. This is the first condition. The second one is if you are between the ages of 60 and 65, you need to cease a gainful employment. All this means is you need to change jobs, or if you had two jobs, as long as you leave one, you can access your super. If you do this at 60, your total balance is now unpreserved. However, any future contributions will be locked if you haven't fully retired and you're still working. Once you hit age 65, you can work as much or as little as you want, and your total super balance is now unpreserved. And you can do whatever you want with it. If you're still working, your employer still needs to pay SG. However, if you want it, the second it went into the account, theoretically you could take it out. When it comes to accessing your super after you pass away, there are a lot of requirements that need to be met. Maybe I won't discuss the difference between tax dependent and super dependent here. That is a video in itself. I'll probably release one next month, we'll see. But in order to get super from a deceased estate, you need to be a super dependent. A lot of people get wills and they believe that their super would be included in that and paid out to the beneficiary that they have in their will. This is not the case. One thing that you need to be aware of is that super is not your money. I mean, it is, but it isn't. You are the beneficial owner of the account, but you are not the owner. The super fund is. Due to this, if you pass away, super is not an estate asset. Your house and your cash will be part of your estate, but your super will be paid out as per the beneficiary nomination that you have made. This means it's super important that your beneficiary on the account is valid and is up to date. The limited beneficiaries that you can name are essentially your estate, your spouse, and your children. You cannot name grandchildren, siblings, parents, nieces, or nephews. That's very limited. If your nomination is not valid, the trustees of the fund can essentially decide themselves who they want to pay the money out to. They have to pay it out. But if you want it to go to your sibling, this is invalid, and they will make their own decision who gets it. You never know if you would be satisfied or not with their choice. Hopefully I've been able to help you better understand the different contributions and the caps and also the requirements to pull money out of super. We'll take a little couple of months break, and soon I'll be talking about pensions. So make sure to subscribe and get notified when that comes out. If you've got any more questions, please feel free to drop a comment below and I'll answer if I can. Thank you guys so much for watching, and I'll see you on the next one.